In this chapter, we are going to analyse companies' stock or inventory. To do this, we have to distinguish the various types of business. Firstly, trading companies. These businesses sell goods purchased for resale in the same state as when they were bought. These goods go into stock awaiting sale. We also have manufacturing companies. These businesses process or manufacture goods. They need stocks of raw materials at the start of the process, and at the end of the process, they have a stock of finished goods. Raw materials are transformed during the production cycle. Finished goods, on the other hand, are goods at the end of the production process that require no further processing before sale. Finally, we have service companies. These businesses also have stocks. It may be that the services being provided are not wholly completed at the balance sheet date. In this case, they make up a stock of work in progress, which is valued at cost price. In this module, we will only examine trading companies' stocks of goods purchased for resale and manufacturing companies' stocks of finished goods. For service companies, work in progress, the principle is the same as that used for stocks of finished goods in manufacturing companies.
We will distinguish between two broad categories of stock: trading companies' stocks of goods purchased for resale and manufacturing companies' stocks of finished goods.
We will look how the stock affect the financial statements. Stock forms part of the company's operating cycle and corresponds to a use of sources of finance. This is, of course, the reason why it is found on the assets side of the balance sheet, within current assets. Because of this, stock has an impact on the company's balance sheet. Since stocks form part of the company's operating cycle as consumption, they also affect the income statement. To understand how stock affects a company's financial statements, we need to remember the following points.
The balance sheet is a snapshot at a given date of the company's sources and uses of finance. The impact of stock on the balance sheet is therefore visible at the end of each accounting period, when we calculate the new stock during the period-end inventory process. We substitute the new total stock balance, called closing stock, for the previous stock total from the beginning of the accounting period, called opening stock. The income statement, on the other hand, is like a film showing all the transactions recorded in it over a given period. The analysis of stock, therefore, has to be broken down into two phases. Firstly, during the accounting period, then at the end of the accounting period.
Let's start with the stocks of goods purchased for resale held by a trading company. The company records sales of goods purchased for resale as revenue in its income statement. We need to be able to compare this revenue to the related expenses. The expenses must therefore relate entirely to purchases that have actually been consumed, that is to say, sold during the accounting period. Throughout the accounting period, the accounting staff record purchases of goods for resale at the right time and for the right amount in the income statement, independently of sales. So the expenses are treated as being consumed immediately. At the end of the accounting period, we move from fiction to reality.
Throughout the year, the accountant treats all purchases as having been consumed. However, this is not what happens in real life. The only goods that have been consumed are those that have been sold, which may not necessarily be the case for all the goods bought during the accounting period. The aim is therefore to move from purchases to consumption, or in other words, from what has been bought to what has been consumed.
The companies Fashion 1 and Fashion 2 buy and sell goods. Drag and drop the figures in the right place to fill in the headings of their income statements.